Hello, everyone. Thank you for joining us today, April 27th. We hope you and your families are doing well as we near the warmer months. With the close of Q1 and continuing rate hikes, it's a good time to touch base and discuss these ongoing rate adjustments. Please keep in mind that anything discussed on the video is not financial, legal, nor tax advice. Please contact us individually to discuss any specific situations. Julian, where is the market today?
The S&P 500 is down approximately 12% year to date. So what you're seeing now is Jerome Powell and the Federal Reserve looking to consistently raise rates over these next several months to combat the level of inflation. Considering that, we wanted to talk about what the implications of these adjustments are.
Currently, the Federal Reserve policymakers are considering a 0.5% increase in interest rates in their May meeting. The strength of the labor market and American consumer has given them the confidence to continue this path as they look to reel in the high level of inflation. The most recent data for the Consumer Price Index, also known as the CPI, shows it has increased 8.5% over the prior year, which is well above the historical average.
With this in mind, and as the Fed tightens policy, it may be useful to consider how markets have behaved in past rate hiking cycles. So since 1983, there have been 6 similar hiking cycles lasting 18 months on average. Taking a look at the chart in front of us, courtesy of our JP Morgan research partners, we can see the average over the last 6 cycles. Looking to the right side, you can see rates increase on average 2.9%, with S&P 500 responding positively by climbing 5.8%. As always, past performance is not indicative of future results, but it's important to note that companies have historically performed strongly during these cycles. Jackie, what takeaways do you have?
So there are 2 key takeaways. First, for bonds, it will be a challenging environment due to the increase in interest rate hikes. However, bonds do remain a key buffer in our portfolios for the long term. Second, stocks tend to perform well when the Fed increases interest rates. Typically, the hikes occur in tandem with strong economic backdrops, just like what we're currently experiencing today. We have positive corporate earnings, above trend growth, and a stronger labor market. What these past few months have really highlighted is the importance of being diversified. In this rising interest rate environment, value stocks have been the ballast of portfolios after being more out of favor for nearly a decade. In fact, value has outperformed growth by over 15% year to date.
As we continue to note, volatility is the price of admission in the market, right? The cost for long-term growth we've all experienced over the last several decades. This is approximately the 38th time since 1950 that there's been a 10% pullback, and I fully expect there to be many more opportunities like this in the future. There will continue to be volatility as the unknowns around rate hikes become known and the geopolitical events settle out, but holding for long-term and remaining diversified have proven to be winning strategies for responsible investors. Thank you everyone for joining us today, and please reach out if you have any additional questions for us.
Thank you, everyone. Have a great day.